On June 15, 2002, Arthur Andersen LLP ceased operations as a public accounting firm. The announcement was quiet, almost administrative in its language, the kind of corporate communication designed to minimize drama while delivering maximum devastation. 85,000 people lost their jobs that day. 28,000 of them were in the United States alone. The rest were scattered across 84 countries where Andersen had built offices over 9 decades of relentless expansion. The firm had been 89 years old. It had survived 2 world wars, the Great Depression, the stagflation of the 1970s, and every market crash in between. It had audited the books of the largest corporations in American history. It had trained 3 generations of accountants who went on to shape the profession in ways that are still visible today. It was destroyed in 90 days, not by a market crash, not by a competitor, not by any of the external forces that typically kill large institutions. It was destroyed by a single client, a single fraud, a single decision to feed a shredder instead of preserve the evidence, and a criminal conviction that made it impossible to continue operating. The client was Enron. The decision was catastrophic, and the story of how it happened begins not in Houston in 2001, but in Chicago in 1913, with a Northwestern University professor who believed that accountants should never, under any circumstances, tell a client what they wanted to hear. Arthur Edward Andersen was born in 1885 in Plano, Illinois, the son of Norwegian immigrants who had settled in the American Midwest with the particular determination of people who have chosen their country rather than inherited it. His father died when Arthur was 11 years old. His mother died 6 years later. At 17, he was an orphan supporting himself through a combination of work and the stubborn intellectual ambition that his parents had apparently deposited in him before they left. He worked as a mailboy at Fraser and Chalmers, a manufacturing company in Chicago, while attending night school. He passed the Illinois CPA examination in 1908 at the age of 23, the youngest person in Illinois history to do so at that time. He joined the accounting firm Price Waterhouse, learned the profession from the inside, and simultaneously pursued an academic career that would define his understanding of what accounting was supposed to be. By 1912, he was a professor at Northwestern University's School of Commerce, teaching accounting to young men who would go on to practice the profession. His classroom manner was apparently direct to the point of severity. He believed that accounting was a moral practice, as much as a technical one, and he communicated that belief with the evangelical consistency of someone who has thought hard about what their field is actually for. What accounting was for, in Andersen's framework, was simple and demanding. It was for telling the truth about money. The auditor's job was to examine a company's books and report honestly to the people whose money was at stake: investors, creditors, the public. This required independence from the company being audited. It required the willingness to report bad news as clearly as good news. It required, above all, the refusal to tell clients what they wanted to hear, when what they wanted to hear wasn't true. In 1913, at the age of 28, Andersen and a partner named Clarence Delaney founded the firm that would bear his name, Andersen, Delaney and Company, later Arthur Andersen and Company. The timing was not obviously auspicious. The accounting profession in 1913 was young, unregulated, and not particularly prestigious. The idea that a 28-year-old could build something of lasting significance from that starting point required a confidence that either bordered on delusion or reflected genuine prescience. It reflected genuine prescience, Andersen's most famous early story involves a client named Joseph Schlitz of the Schlitz Brewing Company, who came to him in 1914 demanding that Andersen approve a set of books that were, in Andersen's professional judgment, inaccurate. Schlitz threatened to take his business elsewhere. Andersen's response, delivered with the directness his former students apparently remembered for decades, was essentially, "There is not enough money in the city of Milwaukee to make me certify numbers. I don't believe." He lost the client. He told the story for the rest of his life. This was not mere professional stubbornness. It was a deliberate philosophy about what made accounting valuable. The auditor's opinion was worth something precisely because it was independent, because clients, investors, and the public could trust that it reflected honest assessment rather than client service. The moment an auditor began shading their opinion to preserve a client relationship, the opinion became worthless. And a worthless audit opinion was not just professionally embarrassing. It was a fraud on everyone who relied on it. Andersen built his firm around this principle. He recruited people who understood it, trained them to apply it, and created a culture that, for several decades, genuinely embodied it. The firm developed a reputation for being difficult, for pushing back on clients, for requiring documentation that clients found burdensome, for refusing to approve accounting treatments that the client's lawyers had argued were technically permissible, but that Andersen's people found misleading. This reputation was an asset. The clients who chose Arthur Andersen chose it precisely because its opinion meant something. Banks extending credit, investors buying shares, partners entering deals. They trusted Andersen's audit opinion in a way that they might not have trusted an auditor known to be more accommodating. Arthur Andersen, the man, died in 1947, at the age of 61. He had built his firm into one of the most respected accounting practices in America. Not the largest, not the most profitable, but the one whose name meant something specific in terms of professional integrity. What happened to the firm after his death was a slow transformation that took 50 years to complete. The integrity remained for a long time because the culture he had built was real and durable, but the pressures that would eventually erode it were already present in the profession and in the economy around the firm. Waiting for the moment when the balance would shift, the moment came. It always does. The accounting profession that Arthur Andersen had entered in 1913 was a modest one. By the 1950s, it had become something considerably larger, a fundamental infrastructure of the American capitalist system, the mechanism through which public companies reported their financial condition to the investors whose capital they depended on. The Securities Acts of 1933 and 1934 passed in the aftermath of the stock market crash, and the revelations about how thoroughly the public had been misled by corporate financial reporting in the 1920s made independent auditing a legal requirement for public companies. Every company whose shares traded on American exchanges was required to have its financial statements audited by an independent certified public accountant. This requirement transformed accounting from a useful service into a mandatory one, and the firms that could provide it at scale became essential participants in American economic life. Arthur Andersen and Company was positioned to benefit from this transformation. The firm had offices in major American cities, a reputation for rigorous work, and the kind of institutional credibility that attracted large corporate clients who needed auditors that banks and investors would trust. The post-war economic expansion filled the firm's client list with industrial companies, banks, consumer goods manufacturers, and the emerging technology firms that were beginning to reshape American industry. The growth was not only domestic. American corporations were expanding internationally in the 1950s and 1960s, and their auditors followed. Andersen opened offices in Europe, Latin America, and eventually Asia, building a global network that mirrored the geographic expansion of American capitalism. By the 1970s, the firm was genuinely international, not just American with foreign offices, but a coordinated, global practice with local partners in dozens of countries. The competitive landscape coalesced into what became known as the Big Eight, the 8 largest accounting firms that dominated the audit market for publicly traded companies in America and, increasingly, globally. Arthur Andersen was one of the 8. Its competitors were firms with similarly old-fashioned, integrity-focused names: Price Waterhouse, Deloitte Haskins & Sells, Ernst & Winnie, Pete Marwick Mitchell, Coopers & Lybrand, Touche Ross, and Arthur Young. The Big Eight competed for the same large corporate clients, trained their staff through similar methodologies, and maintained, collectively and individually, the professional culture that the regulatory framework required. The appearance, at minimum, and often the reality, of genuine independence from the clients they audited. The appearance began to separate from the reality in the 1970s and 1980s under pressures that came from multiple directions simultaneously. The first pressure was consulting. Accounting firms discovered that their client relationships, built on the trust and access that audit work provided, were a platform for selling other services. Tax advice, management consulting, technology implementation, financial advisory work, all of these could be sold to audit clients who already trusted the firm and whose internal operations the firm already understood from the audit process. The consulting revenue was, from the beginning, more attractive than audit revenue. Auditing was competitive, price-sensitive, and increasingly commoditized. Companies were getting better at using the public accounting requirement to extract price concessions from audit firms competing for their business. Consulting was neither competitive in the same way, nor price-sensitive in the same degree. A management consulting engagement that helped a company restructure its operations or implement a new technology platform could generate fees an order of magnitude larger than the annual audit. Arthur Andersen built a consulting division, eventually called Andersen Consulting, that became one of the most significant technology and management consulting businesses in the world. By the 1990s, the consulting division was generating more revenue than the audit division, employing more people, and occupying a more prominent position in the firm's strategic thinking. This created a structural problem that everyone in the profession understood, and nobody wanted to address directly. The audit division's independence, the quality that made its opinions valuable, depended on its willingness to deliver bad news to clients. The consulting division's revenue depended on maintaining warm, collaborative, long-term relationships with those same clients. These objectives were not compatible. An auditor who knew that their firm was simultaneously pitching the client's CFO on a $50 million technology implementation was not in the same psychological position as an auditor whose only relationship with the client was the annual examination of the books. The consulting tension eventually produced one of the most expensive divorces in professional services history. Andersen Consulting and Arthur Andersen, Audit and Consulting, had been in conflict over revenue sharing and strategic direction throughout the 1990s. In 2000, an arbitration panel ruled that Andersen Consulting could separate from the parent firm, paying $1.2 billion to do so. The consulting division renamed itself Accenture, which went on to become one of the largest consulting businesses in the world. Arthur Andersen kept the audit business, and it kept the culture that the consulting years had produced. A culture oriented toward client service, toward revenue growth, toward the maintenance of relationships that generated fees, and away from the uncomfortable independence that Arthur Andersen, the man, had made the firm's founding principle. The Big Eight had also contracted. Mergers and collapses through the 1980s and 1990s reduced it to the Big Six, then the Big Five. Arthur Andersen was one of the five. Its competitors were PricewaterhouseCoopers, Deloitte & Touche, Ernst & Young, and KPMG, firms that had each undergone their own versions of the culture shift that the consulting revenue had produced across the profession. The profession had also been through its first major scandal cycle. The savings and loan crisis of the 1980s had involved audit failures at numerous institutions. Accounting firms had certified financial statements that turned out to be severely misleading, and the federal government had eventually spent roughly $125 billion cleaning up the mess. The accounting profession had been investigated, criticized, and subjected to various reform proposals, most of which went nowhere, because the firms that would have been regulated were effective participants in the political process that determined whether regulation happened. Arthur Andersen had been implicated in several of the savings and loan failures. It had paid settlements, significant ones, that attracted some attention without producing the kind of institutional soul-searching that might have changed the trajectory. The settlements were treated as cost of business. The culture that had produced the failures was adjusted at the margins without being fundamentally reconsidered. By the late 1990s, Arthur Andersen was a firm of approximately 85,000 people, operating in 84 countries, generating billions in annual revenue, and carrying the name of a man who had once told the city of Milwaukee it wasn't rich enough to buy his professional opinion. The name remained. The principle was in more ambiguous condition, and in Houston, Texas, a client named Enron was growing into the kind of company that a truly independent auditor would have found deeply troubling, and that Arthur Andersen was finding deeply profitable. The transformation of Arthur Andersen, from the firm that Arthur Andersen the man had built into the firm that would destroy itself over Enron, was not a sudden event. It was a gradual erosion conducted over decades that left the external appearance of integrity largely intact while hollowing out the substance beneath. The hollowing out had a mechanism. It was called the client service model, and it was the dominant cultural framework of the firm's leadership from the 1980s onward. The client service model held that the firm's primary obligation, the one that determined how partners were evaluated, compensated, promoted, and ultimately defined within the institution, was to serve clients, to be responsive, to be helpful, to find solutions, to maintain relationships. This is not, on its face, unreasonable. Every professional services firm exists to serve clients, and a firm that doesn't serve clients well doesn't stay in business. The problem was what happened to the concept of service when it was applied to auditing specifically. Audit work is, by regulatory definition and professional standard, supposed to be independent. The auditor is not serving the management team that hired them. The auditor is serving the investors, creditors, and other stakeholders who rely on the audit opinion to make decisions about the company. When there is a conflict between what management wants the audit to show and what the underlying facts support, the auditor's obligation is to the facts and to the users of the financial statements, not to the management team that signs the engagement letter. The client service culture applied to auditing, quietly inverted this structure. Partners were measured on client satisfaction scores. Client satisfaction, unsurprisingly, correlated with how helpful the auditor was in finding accounting treatments that the client found acceptable. Partners who pushed back too hard on clients lost relationships, lost revenue, lost standing in the firm's internal hierarchy. The culture didn't announce this inversion. It didn't issue a memo saying that audit independence was now subordinate to client relationships. It accomplished the same thing through the quieter mechanisms of incentive, through who got promoted, who got credit for growing revenues, whose judgment was trusted when conflicts arose between what the client wanted and what the accounting standards technically required. The firm's quality control partner in Houston in the late 1990s was a man named Carl Bass. His job was to review technically complex accounting questions that arose on client engagements and provide independent professional judgment about the appropriate treatment. He was, in the structural logic of the firm, supposed to be the backstop, the person who could say, without regard to client relationship management, whether a proposed accounting treatment was acceptable. Enron's management didn't like Carl Bass. He had raised objections to several Enron accounting treatments that Enron's finance team found inconvenient. He had noted, in the careful language of professional accounting review, that certain structures Enron was using to move liabilities off its balance sheet and recognize revenue in ways that flattered. Its reported earnings were not clearly supportable under generally accepted accounting principles. In February 2001, at Enron's request, Carl Bass was removed from the Enron engagement. Read that sentence again. A client of Arthur Andersen requested that a specific Arthur Andersen partner be removed from the team reviewing that client's books, because that partner was being too rigorous, and Arthur Andersen complied. This was not a minor procedural adjustment. It was a complete inversion of the auditor-client relationship. The auditor is supposed to be independent of the client. The quality control reviewer is supposed to be independent of the engagement team. The idea that a client could request the removal of the person whose job was to provide independent professional judgment, and that the firm would honor that request, describes a firm that had abandoned the foundational principle of its profession. The fee structure around the Enron engagement made the compliance comprehensible, if not defensible. Arthur Andersen was earning approximately $52 million annually from Enron by 2001, $25 million in audit fees, and $27 million in consulting and other advisory fees. Enron was one of the firm's largest clients. The Houston office's financial performance was substantially dependent on the Enron relationship. The partners responsible for the engagement were financially rewarded based on the revenue it generated. The Houston office had also developed a culture of unusual deference to Enron specifically. The company was run by Jeffrey Skilling and Kenneth Lay, men who projected an aura of intellectual sophistication and financial innovation that was genuinely impressive to outside observers. Enron was a darling of Wall Street, of business journalism, of the MBA programs that were producing the next generation of business leaders. Fortune magazine named it America's most innovative company 6 years in a row. The idea that Enron's financial reporting was fundamentally fraudulent required not just professional skepticism, but a willingness to reach a conclusion that virtually every other sophisticated observer had declined to reach. The specific accounting issues at Enron were not simple. They involved special-purpose entities, off-balance sheet structures with names like Raptor and LJM, that were used to shift liabilities away from Enron's reported financial statements and to generate reported income that didn't reflect any underlying economic reality. The structures were complex enough that their true nature required genuine expertise to evaluate, and they were presented to Andersen's auditors with the full force of Enron's legal and financial teams arguing that they were permissible. They were not permissible. The structures violated the spirit, and in several cases the letter, of accounting standards that were specifically designed to prevent exactly the kind of balance sheet manipulation that Enron was conducting. The Andersen auditors who reviewed them, or at least the Carl Bass who reviewed them and raised concerns, understood this. The firm chose to accept Enron's arguments rather than Bass's concerns. The decision was financial. It was also cultural, the product of a decade and more of culture change that had reoriented the firm's identity from independent professional to client service provider. An independent professional says no when the accounting doesn't work. A client service provider finds a way to say yes. Andersen found a way to say yes to Enron for years. The consequences were not abstract. The investors who bought Enron stock based on financial statements that Andersen had certified were investing in a fiction. The employees who held Enron stock in their retirement accounts were trusting their futures to a fraud that their company's auditor had signed off on. The banks that extended Enron credit based on its reported financial condition were lending against assets that didn't exist in the form described. When Enron began to unravel in late 2001, when the Wall Street Journal's reporting and then the SEC's investigation began pulling at the threads of the special purpose entity structure, the scale of what had been concealed became visible with a speed that was almost physically shocking to observers who had believed in the company. Andersen was watching a client collapse. It was also watching the evidence of its own professional failures come into public view. The collapse of Enron in the fall of 2001 is one of the most documented corporate failures in American history, but its specific relevance to Arthur Andersen's destruction requires understanding not just what Enron did, but what Andersen knew, when it knew it, and what it did with that knowledge. Enron's business model, in its honest description, was an energy trading operation, a company that bought and sold natural gas, electricity, and eventually a bewildering range of other commodities and financial instruments. In its dishonest description, the one that its executives presented to the public and that its auditors certified, it was a fast-growing, highly profitable, innovative company that was transforming multiple industries simultaneously through the application of sophisticated financial technology. The dishonest description depended on accounting. Specifically, it depended on mark-to-market accounting for long-term energy contracts, which allowed Enron to recognize the full estimated future value of a contract in the period it was signed, rather than recognizing revenue as it was actually earned. This accounting treatment was technically permissible for certain types of trading activities, but Enron applied it to contracts that didn't fit the standard, generating enormous reported profits from deals whose actual economic value was far lower and whose actual cash generation was essentially zero. The mark-to-market approach created a machine that required perpetual growth. To maintain reported earnings, Enron had to keep signing new contracts whose estimated future value could be booked immediately, covering the gap between reported income and actual cash generation. This was structurally similar to a Ponzi scheme. The reported numbers looked good as long as new activity kept coming in, and the moment growth slowed, the gap between appearance and reality would become visible. The special purpose entities were the mechanism Enron developed to manage this gap and to solve other problems that the mark-to-market approach generated. When an investment that had been booked at optimistic estimated value declined in actual value, Enron transferred it to a special purpose entity, an off-balance sheet structure that was nominally independent of Enron, but was in practice controlled by and guaranteed by Enron. The declining asset disappeared from Enron's balance sheet. The special purpose entity absorbed the loss. Enron's reported financial condition looked clean. The accounting standards required that a special purpose entity be genuinely independent of the sponsoring company, controlled by independent outside investors who had contributed at least 3% of the entity's capital. Enron's SPEs did not meet this standard. The outside investors were effectively guaranteed against loss by Enron itself, meaning they bore no real economic risk, meaning the independence was fictional, meaning the SPEs should have been consolidated into Enron's financial statements and the liabilities reported on Enron's balance sheet. Arthur Andersen's auditors knew about the SPE structures in detail. Their job was to know about them. Evaluating complex transactions was exactly what audit work required. The question they faced was whether the structures met the accounting standards or didn't. Carl Bass had concluded they didn't. He had been removed from the engagement. The partners who remained on the engagement reached a different conclusion. They concluded, or at least they certified financial statements whose validity depended on concluding, that the SPE structures were permissible, that the outside investor arrangements met the independence standards, and that Enron's financial statements fairly presented its financial condition. They were wrong, and the wrongness was not subtle. It was not a borderline case where reasonable professionals could reach different conclusions. The outside investors in Enron's SPEs were not independent. Their capital was effectively guaranteed by Enron. The structures failed the accounting standards on their fundamental terms. The wrongness produced the largest misstatement of corporate earnings in American history to that point. Enron's reported net income for the years 1997 through 2001 was overstated by approximately $600 million. Its reported debt was understated by billions. The financial condition that Andersen had certified year after year was a fiction. When the Wall Street Journal published its first major investigation of Enron's SPE structures in October 2001, the story produced the kind of market reaction that follows genuine revelations about financial fraud. Enron's stock price began falling with a momentum that nothing could arrest. Investors who understood what the SPE story meant were selling. The banks that had provided credit facilities began looking more carefully at the underlying assets. The rating agencies that had maintained investment-grade ratings on Enron's debt began reviewing their assumptions. Enron's management attempted to manage the unraveling through a combination of additional disclosures, asset sales, and, with increasing desperation, the search for a merger partner who could absorb the company before its situation became publicly unmanageable. Dynegy, a smaller energy company, briefly agreed to acquire Enron, then withdrew. When its own due diligence revealed that Enron's actual financial condition was substantially worse than its public disclosures had indicated. On December 2, 2001, Enron filed for bankruptcy. It was the largest corporate bankruptcy in American history at that time. 20,000 Enron employees lost their jobs. Enron's retirement plan had encouraged employees to hold Enron stock, and when the stock collapsed from its peak of $90 to essentially zero, employees who had spent careers building retirement savings in company stock watched those savings evaporate. The investors who had bought Enron shares based on financial statements certified by Arthur Andersen had lost billions. The banks that had extended credit had lost billions more. The pension funds, the retail investors, the employees, the full range of people whose financial decisions had been based on the false picture that Enron's management had painted and that Andersen had certified, were the victims of a fraud that had operated in plain sight because the institution whose job was to catch it had stopped being the institution that could catch it. The Department of Justice and the SEC began investigations simultaneously. The question for both was not just what Enron had done. That was becoming clear with terrible speed, but what Andersen had known and when, and whether of false financial statements constituted a crime. For Andersen, the crisis arrived with a clarity that was almost merciful in its definitiveness. The firm had certified fraudulent financial statements. Its largest client was bankrupt. Federal investigators were coming. The evidence of what had been approved over years of engagement was sitting in the files. The response to this situation would determine whether Andersen survived. The response that the firm chose was to feed the documents into a shredder. The decision to destroy documents related to the Enron audit was made at the Arthur Andersen Houston office in October 2001, before Enron filed for bankruptcy, before federal charges were filed, but after the Wall Street Journal's reporting had made clear that Enron's financial situation was under serious scrutiny and that the auditors who had certified it would inevitably face questions. The specific sequence of events has been reconstructed through the testimony of Andersen employees, email records that survived the shredding, and the subsequent criminal trial. The reconstruction is not complete. The documents that would have filled in the gaps were the ones being destroyed, but the outline is clear enough to understand what happened and why. David Duncan was the lead partner on the Enron engagement. He was 40 years old in 2001, a Houston native who had worked on the Enron account for most of his career at Andersen. His professional identity was substantially built around the Enron relationship. His compensation was substantially determined by the revenue that relationship generated. His standing in the Houston office was substantially defined by his position as the man responsible for Andersen's most important local client. When the Enron situation began to deteriorate in October 2001, Duncan was in an impossible position. He knew what was in the Enron files. He knew what Carl Bass had said about the SPE structures. He knew what the engagement team had concluded and why and how those conclusions had been reached. He knew, with the professional certainty of someone who had spent years on the account, that the materials in those files would not look good to federal investigators. On October 12, 2001, Nancy Temple, an Andersen attorney at the firm's Chicago headquarters, sent an email to the Houston engagement team reminding them of the firm's document retention policy. The policy allowed for the destruction of documents that were not subject to a legal hold, working papers, drafts, and other materials that had been superseded or were not required for the final audit file. The email has been characterized differently by different parties. Andersen's lawyers argued it was a routine reminder of a standard policy. Federal prosecutors characterized it as a signal, not explicit enough to constitute an instruction, but clear enough in context to communicate that document retention policy was a subject of current interest. What happened after the email is not in significant dispute. Beginning in mid-October, the Houston engagement team began a document destruction effort that went substantially beyond normal file maintenance. Boxes of documents were shredded. Email files were deleted. Electronic records were wiped. The destruction continued for weeks with a speed and thoroughness that reflected something other than routine file management. The scale was significant. Andersen employees later testified that the shredding was essentially full-time work for extended periods, that the volume of documents being destroyed was large enough to require sustained effort over multiple weeks. One employee described the office's shredder as running almost continuously. On November 8, 2001, the SEC issued a formal document preservation subpoena to Andersen. The subpoena made explicit what had been implicit since October, that Andersen was the subject of a federal investigation and that destruction of relevant documents was now clearly illegal. The shredding stopped. David Duncan later testified that when he heard about the SEC subpoena, he understood immediately that the document destruction had been a catastrophic mistake. He understood it in the specific way that a lawyer understands it. Not because destroying documents you're embarrassed about is uncommon, but because destroying documents after you have reason to believe a federal investigation is coming, and then destroying more after a subpoena is issued, is obstruction of justice. The Department of Justice agreed. In March 2002, the DOJ indicted Arthur Andersen LLP, the entire firm, not individual partners, but the institution itself, on one count of obstruction of justice for the destruction of Enron-related documents. The decision to indict the firm rather than individuals was one of the most consequential prosecutorial choices in American legal history, though its consequences only became visible in retrospect. At the time, the DOJ's theory was that the destruction had been widespread enough and institutional enough, involving multiple partners and employees across the engagement team, to warrant charging the firm. Individual prosecutions of Duncan and Temple could proceed separately. The institution bore responsibility for institutional conduct. What the prosecutors did not fully weigh, or did not weigh sufficiently, was the consequence of an indictment on a professional services firm whose product was a license that depended on regulatory standing. Arthur Andersen could not audit public companies if it were convicted of a felony. Public companies could not use an auditor that had been convicted of a felony, the indictment itself. Before any trial, before any verdict, began immediately destroying the client relationships that were the firm's economic foundation. The clients started leaving, not all at once, and not without expressions of sympathy and regret, but with the steady and irreversible momentum of large organizations protecting themselves from association with a firm that might not survive. Delta Airlines moved its audit to Deloitte. Freddie Mac moved to PricewaterhouseCoopers. FedEx moved to Ernst & Young. The departures accelerated as the trial date approached. The firm attempted to negotiate a settlement, a deferred prosecution agreement, or a plea arrangement that would resolve the charges without a conviction. The DOJ declined. The message from Washington, in the aftermath of Enron, and the beginning of what would become the Sarbanes-Oxley era of corporate governance reform, was that accommodation for accounting firms that had abetted corporate fraud was not available. David Duncan pleaded guilty to obstruction of justice charges and agreed to cooperate with federal investigators. His cooperation meant that the government's case against the firm rested on testimony from the lead partner on the Enron engagement, who had admitted to destroying documents and was prepared to explain in detail what he had destroyed and why. The trial began in May 2002. The defense argued that the document destruction was consistent with Andersen's standard document retention policy. and that no one had been instructed to destroy materials specifically to impede the federal investigation. The prosecution argued that the volume, timing, and focus of the destruction made any other interpretation implausible. The jury convicted Arthur Andersen LLP of obstruction of justice on June 15, 2002. On that date, 85,000 people lost their jobs. The collapse of Arthur Andersen was not a slow decline. It was an institutional execution, swift, complete, and irreversible in a way that distinguished it from every other major corporate failure of the era. Enron had been large. WorldCom, whose accounting fraud was revealed in the same general period, was larger. Both bankruptcies destroyed enormous amounts of shareholder value and employee savings and public trust. But both institutions left successors, reorganized entities that continued in some form, assets that were absorbed, operations that continued under different names. Arthur Andersen left nothing. The firm ceased to exist as a professional entity. Its offices closed. Its partnerships dissolved. Its client relationships transferred to competitors who had been waiting, with the particular patience of people who understood that the waiting would not be long, for the accounts to become available. The speed of the dismantling was its own kind of violence. A firm that had taken 89 years to build was functionally over in the time it takes to plan a wedding. The June 15, 2002 announcement that Andersen would stop auditing public companies was the formal declaration of something that had been economically true for weeks. By the time the words were made official, most of the clients were already gone. Most of the senior talent had already accepted offers elsewhere, and most of the firm's physical infrastructure was in the process of being absorbed, sold, or simply abandoned. The 85,000 employees who lost their positions were not, for the most part, people who had been involved in the Enron engagement or in the document destruction. They were accountants and consultants and administrative staff in offices across 84 countries who had spent careers building expertise and client relationships within an institution that was now simply gone. Many of them had known for months that the firm was unlikely to survive the trial. That foreknowledge did not make the end easier. What foreknowledge actually produced, in most cases, was a prolonged professional anxiety that the end finally resolved into something almost like relief. The uncertainty had been its own particular torture. Watching clients leave, watching colleagues accept offers at competing firms, watching the leadership issue increasingly implausible statements about the firm's future prospects while the evidence pointed uniformly in one direction. When the end arrived, it at least replaced the uncertainty with a fact. The fact was devastating, but it was navigable in a way that sustained uncertainty is not. The human texture of those final months has been documented in memoirs, journalism, and the kind of oral history that only survives through the people who lived it. An Andersen partner in Dallas, who had spent 20 years building a client base that evaporated in 3 months. An audit manager in London who had 3 competing job offers but couldn't decide which firm to trust with what remained of her career, because she had trusted Andersen, and that had ended this way. A first-year associate in Tokyo whose accounting career had begun and effectively ended in the same calendar year, before she had learned enough of the profession to evaluate what she had lost. These are not statistics. They are the human cost of institutional failure. Specific people whose professional trajectories were interrupted or permanently altered by decisions made by partners they had never met on an engagement in Houston that was geographically and professionally remote from their own work. The aftermath settled into patterns that varied by geography and seniority. Senior partners who had capital accounts in the partnership, received distributions from the liquidation of firm assets, amounts that were, depending on the individual's position and the specific settlement arrangements, either modest compensation for the destruction of their practices or significant payouts that reflected years of accumulated partnership equity. Junior staff received severance where the local employment laws required it, and found themselves in a suddenly crowded job market as 85. 00 accountants simultaneously competed for positions at the 4 remaining major firms. The absorptions were not uniform. PricewaterhouseCoopers took on significant portions of Andersen's practice in certain markets. Deloitte absorbed others. Ernst & Young and KPMG each took what they could manage. In some countries, entire Andersen national practices were transferred largely intact, rebadged, restructured, but functionally continuous with what had existed before. In others, the dissolution was genuinely atomizing, with individuals dispersing individually rather than in coherent groups. The client transfers were similarly varied. Some of Andersen's largest clients had relationships with specific partners, relationships that were personal enough that when the partner moved to Deloitte, the client followed the partner rather than evaluating the competing firms on their merits. Others used the disruption as an opportunity to conduct proper competitive processes that they probably should have conducted years earlier. A handful decided that the Andersen situation had shaken their confidence in large accounting firms generally and explored whether mid-size firms could meet their needs. The Big Five became the Big Four: PricewaterhouseCoopers, Deloitte & Touche, Ernst & Young, and KPMG, an oligopoly of audit providers for the largest public companies in the world. The concentration has never reversed. The accounting profession today remains a Big Four industry, with those 4 firms auditing the vast majority of Fortune 500 companies and their global equivalents. This concentration was one of the lasting structural consequences of Andersen's collapse, and it created its own set of problems that the profession and its regulators have been managing ever since. When there are only 4 firms large enough to audit the largest companies, and when one of those 4 gets into serious trouble, there is no credible mechanism for removing it from the market. A second Big Four failure would reduce the audit market for large public companies to 3 firms, a concentration that would create regulatory, competitive, and conflict of interest problems that would be extremely difficult to manage. The Big Four are, in practice, too systemically important to be prosecuted in the way that Arthur Andersen was prosecuted. This is not a comfortable realization. It means that the lesson the DOJ intended to teach, that accounting firms would face institutional consequences for abetting corporate fraud, was learned precisely once and then rendered unlearnable. You cannot indict KPMG. You cannot indict Deloitte, not because they are beyond the law, but because indicting them would create a market failure in a profession whose functioning is a regulatory requirement for the entire public company universe. The tool that destroyed Andersen cannot be used again without producing consequences worse than the problem it solves. This recognition arrived too late for Andersen. In 2005, the United States Supreme Court unanimously overturned Arthur Andersen's obstruction of justice conviction. The court found that the jury instructions at trial had been overly broad, that the definition of corrupt persuasion used in the instructions could encompass entirely innocent conduct, and therefore didn't adequately define the criminal intent required for conviction. The conviction was vacated. The matter was remanded for possible retrial. There was no retrial. By 2005, Arthur Andersen had been gone for 3 years. the firm no longer existed as a legal entity capable of being tried. The employees had dispersed. The clients had left. The partnership had been dissolved. The conviction that had accelerated all of that was now, technically, a nullity. But the nullity arrived 3 years too late to matter to the 85. Xero's people who had lost their jobs when the original verdict came in. The Supreme Court's decision produced a specific kind of retrospective horror among people who had followed the case. The firm had been destroyed by a criminal conviction that was subsequently overturned on legal grounds. The prosecution that had been central to the government's response to the Enron scandal had targeted an institution rather than individuals, and the institutional target had ceased to exist before the legal process finished evaluating whether the prosecution had been conducted correctly. The legal scholars who studied the decision identified a precise and troubling irony in its timing. The court's reasoning that the jury had been instructed using a definition of obstruction broad enough to criminalize behavior that fell short of genuine corrupt intent was a point of genuine legal merit. The instructions had been flawed. The conviction should not have stood on those instructions. The court was right in the narrow legal sense, and none of that rightness did anything at all for the 85,000 people who had already lost their livelihoods on the basis of a verdict that was now declared defective. The law moved at its own pace. The economy had moved faster. By the time the Supreme Court finished its deliberations, the entity it was adjudicating had been reduced to a few remaining employees managing the wind down of affairs that had no other logical end. The individuals most directly responsible for the decisions that destroyed the firm faced varied consequences. David Duncan, who had pleaded guilty to obstruction and cooperated with federal prosecutors, ultimately had his guilty plea withdrawn after the Supreme Court decision, since the conduct to which he had pleaded was no longer clearly criminal under the court's interpretation of the statute. He returned to accounting practice in a diminished capacity. He has not spoken extensively in public about his role in the events. Jeffrey Skilling, Enron's chief executive, was convicted of multiple counts of securities fraud and other charges, and sentenced to 24 years in prison. A sentence later reduced to 14 years after his appeal established that certain charges had been improperly handled. He was released in 2019. Kenneth Lay, Enron's founder and chairman, was convicted on multiple counts, but died of a heart attack before sentencing, and his conviction was vacated by the court because he had not had the opportunity to appeal. Andrew Fastow, Enron's chief financial officer and the architect of the SPE structures that Carl Bass had objected to, pleaded guilty to 2 counts of wire fraud and securities fraud and served 6 years in prison. He has subsequently spoken and written about his conduct, with what appears to be genuine reflection about the culture that made his actions possible. His public appearances in the years since his release have been notably candid. He has described in specific terms how the incentive environment at Enron made his choices feel rational at the time, and how the absence of anyone willing to say a clear and unambiguous, no-made escalation feel like a natural next step rather than a moral threshold. That candor is its own kind of documentation. It describes, from the inside, exactly the culture that the Andersen audit team was operating within. A culture in which the people empowered to say no had been systematically removed or sidelined, in which professional objection was treated as an obstacle to manage rather than a signal to heed. Nancy Temple, the Andersen attorney, whose email was central to the prosecution's narrative of the document destruction, was not charged criminally. She faced professional consequences and left the practice of law. The regulatory consequences of the Enron scandal extended well beyond Andersen. The Sarbanes-Oxley Act of 2002 passed with unusual bipartisan speed in the political environment following Enron, WorldCom, and several other major accounting scandals, fundamentally restructured the regulatory framework for public company accounting. The Act established the Public Company Accounting Oversight Board, a new regulatory body with authority to inspect accounting firms, set auditing standards, and sanction firms and individuals for deficient audit work. For the first time, the accounting profession was subject to genuine external oversight, rather than the self-regulation that had allowed the culture shifts of the 1980s and 1990s to proceed without meaningful external check. The PCAOB has been variously criticized for being too aggressive and too lenient. It inspects firm audit work and issues findings that it makes public, but its existence represents a structural change in how accounting firms are held accountable. The Sarbanes-Oxley Act also addressed the consulting conflict directly, prohibiting accounting firms from providing certain consulting services to companies they audit. The prohibition has been implemented with varying degrees of effectiveness. The line between permitted and prohibited services has required ongoing regulatory interpretation, but the principle that audit independence is compromised by consulting relationships was finally, after decades of industry resistance, embedded in law. Section 404 of the Act, which required management and auditors to assess and report on the effectiveness of internal controls over financial reporting, was perhaps the most operationally significant provision for the audit profession. It created a new category of audit work that was substantial, recurring, and not easily commoditized. It also created a new category of client-auditor interaction, in which the auditor was explicitly required to evaluate and potentially disagree with management's own assessment of its internal systems. The provision had its critics. The compliance costs for smaller public companies were significant, but it restored, in at least this dimension of audit work, a clear structural requirement for the kind of independent, professional judgment that the Andersen-Enron relationship had abandoned. Whether these reforms have permanently changed the culture of the accounting profession is a question that remains genuinely open. The Big Four firms that absorbed Andersen's practice were, in 2002, the same firms that had their own consulting revenue pressures, their own client service cultures, their own histories of finding ways to accommodate clients whose accounting preferences were at the aggressive end of what standards permitted. The regulatory framework changed. The economic incentives that had produced the culture change did not disappear. These reforms came too late for Arthur Andersen. They were built on the wreckage of the firm that their absence had helped destroy. The question that the Andersen story raises, the one that doesn't have a comfortable answer, is whether what happened was primarily a story about individual failures or institutional ones. The individual failures were real. David Duncan's decision to allow or encourage document destruction was a catastrophic professional and personal failure. The partners who removed Carl Bass from the Enron engagement in response to client pressure made a decision that was wrong in a way they understood. The executives who signed off on the SPE structures that Carl Bass had objected to chose client revenue over professional judgment in a way that had consequences they could have foreseen. But individual failures of this magnitude don't emerge from vacuum. They emerge from institutions that have created the conditions, the incentives, the culture, the implicit permissions. that make such failures possible. The Arthur Andersen that destroyed itself over Enron was not the Arthur Andersen that Arthur Andersen the man had built. It was an institution that had been systematically transformed over decades by incentive structures that rewarded client service over professional independence. The transformation was not secret. It was visible in the firm's internal culture, in the compensation systems, in the metrics by which partners were evaluated and promoted. People inside the firm who cared about the original values were aware of the direction of change. Some of them left. Some of them raised concerns that were addressed at the margins without changing the trajectory. Some of them adapted to the new culture and made peace with what it required. The accounting profession as a whole was undergoing the same transformation. Arthur Andersen was not uniquely corrupt. It was the firm whose corruption happened to intersect with Enron, whose collapse was large enough and public enough to bring everything into the open. Other Big Five firms had their own accounting failures, their own client service cultures, their own stories of professional judgment subordinated to relationship management. They survived because their specific failures were smaller or less publicly catastrophic, or emerged in regulatory environments that were more willing to accommodate settlements than the post-Enron DOJ. Arthur Andersen became the example because it was the example. Its 89 years of history, its genuine founding principles, the name of the man who had told Milwaukee it wasn't rich enough to compromise his judgment. All of it concentrated into the story of a firm that had forgotten what it was for, that had fed documents into a shredder to cover what forgetting had produced, and that had paid for forgetting with its existence. The lesson that the Andersen story offers is not that accounting firms are uniquely corrupt, or that corporate culture is inevitably self-defeating. It is more specific and more unsettling. It is that institutions built on integrity are not self-maintaining. The integrity has to be actively chosen every day in the specific decisions that define the culture, in who gets promoted, what conduct is rewarded, whose objections are taken seriously, what happens when client pressure and professional judgment point in different directions. Carl Bass understood this. He raised his objections through the proper channels. He was removed from the engagement for raising them. In a firm with a functioning integrity culture, his removal would have been the scandal. In the Arthur Andersen of 2001, it was simply a personnel adjustment, handled quietly, noted by the people who needed to note it, and filed away in the collective institutional memory as evidence of how things actually worked. That filing away, that accumulation of unaddressed signals about the gap between stated values and operational reality, is what organizational collapse actually looks like from the inside. Not a single catastrophic decision, but 100 smaller ones, each of which slightly widened the gap between what the institution said it was and what it had actually become. By the time the catastrophic decision arrived, the shredder, the documents, the obstruction, the institution had been preparing for it for years without knowing that was what it was doing. Arthur Andersen, the man, made those choices correctly. He lost Milwaukee rather than compromise his opinion. He built a firm on the principle that the auditor's value was entirely dependent on independence, and that independence was entirely dependent on the daily willingness to say no. For several decades, the firm maintained those choices. Then the consulting revenue arrived, and the client service culture arrived with it, and the choices began to go the other way. By the time the Enron engagement team was feeding documents into a shredder in October 2001, the distance from the founding principle was not measured in months or years, but in decades of accumulated compromise, each one small enough to seem manageable, collectively large enough to destroy an institution that had survived nearly a century of everything else. The shredder ran. The documents disappeared. The firm disappeared with them. 89 years, 90 days, 85,000 people. That is what it costs when an institution forgets what it's for.